Manju still recognized the TV news leaders.
So shall we start? We'll start with it. So you are ready? You are ready, no? Okay, fine. Yeah. Okay. We'll do it in a chat only. I will message in WhatsApp. What it is. Okay. Yeah. So she cannot do the research.
A very warm good morning and a hearty welcome to everyone. SDM College of Business Management proudly organizes a national webinar on investments in stock market during pandemic. Today, the global economy is being shaped by a series of critical changes, not only in finance, but also by social and environmental challenges. At this outset, we can develop a sense of understanding about the current financial situation, and it is important for us to realize that stock market is one of the barometers of a country's economic development. Keeping this in mind, SDM College of Business Management has put its efforts in bringing forth this contemporary topic through this webinar. I am pleased to welcome our resource person, Mr. Yonil D'Souza, for this session. I extend a warm welcome to our beloved principal, Professor Aruna P. Kamal. I extend a cordial welcome to all the participants who are eagerly waiting to enrich their knowledge through this insightful session. It's my privilege to introduce to you the resource person of today's session, Mr. Yonil D'Souza, who is going to talk to us about the investment in stock market during pandemic. Insights into this area can ensure our financial future. At present, Sir is associated with investment services professional based in Mangalore. Our speaker has corporate experience with JP Morgan Chase and has interned at Colaggo and Arendha Investment Services, Mangalore. Interacting with the young minds and having discussion on money are the things which Sir does passionately. Sir is very much interested in having conversation with the public, and he also adds that the credit of being a public speaker goes to Club of Toastmasters International. We are eager to listen to you, sir. Hope this webinar proves to be a fruitful session for the participants. Have a great listening to everyone. Over to you, sir.
He's presenting. Yoni. Can you pass it Hello, Mr. Water. No, we can't hear you, sir. Where is he? 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 Tilak, please bear with us for 5 minutes. Some technical issue. No, he is calling me, I guess. I am calling out the check mode. Hello. No, we can't hear. We can't hear you, Yonin. Sure. Your microphone is proper. You do one thing, one thing is, rejoin, no, you join from your this one mobile also. Yeah, yeah. Some setting I guess. Yeah, yeah. Rejoin, he'll rejoin.
Check. Am I audible?
Yes.
Huh?
Now,
Right? I'm audible,
yeah.
right? Oh,
Yeah, audible.
once again, I would like to confirm if I'm audible before I head with the presentation. And is my screen visible?
Yes, yeah, everything.
Uh, and I would like to thank the SDM College for invitation for me to come here and address you all on this occasion. So before I head, if not for COVID-19, I wouldn't really want to thank COVID-19, but if not for it, I don't think we would have had a discussion here this morning. But COVID-19 is a kind of a pandemic that has affected all our lives. Uh, so every cloud, I know it's a bad thing, but every cloud I consider it to be a silver lining, and we have developed certain aspects in our life which we thought we were never capable of. And online sessions, though we had an option earlier, we never really made use of it. Uncertainty equals reality. COVID-19 uh, has reminded us that uh, our life is uncertain. We do not, as human beings, we do not really like uncertainty. We like something that is very certain. I know we all hope that things will be normal, but still, back of our minds, we have this doubt whether we will have it tomorrow, whether things will be all right tomorrow. We have these things in our minds, and when we have uncertainty around, it really affects our decision making. And when it comes to uncertainty, I'm reminded of my investment teacher who always keeps saying there are two things in life. There are things which you have a control on, and there are things which you do not have a control on. Focus on things which you have control. And if you reflect on this, there are very few things in life which we have a control on. And what we need to do is exercise our right. And there is a second thing that I would like to mention. Warren Buffett is one of the world's greatest investor. He addresses the concern of uncertainty in a few words. Before I get into it, I will let you know what exactly he means by Dow. Dow is nothing but it is something similar to what we have a Sensex in India. Dow is a representation of the US stock markets. What do the stock markets do? What do the stock markets represent? As Madam in the introduction she mentioned, stock markets are nothing but a barometer of the economy in the long run. So let me read out the quote. In the 20th century, the United States endured two world wars. There were other traumatic and expensive military conflicts. There was a depression. This was not a normal depression, it was a great depression that lasted for almost 10 to 12 years. There were a dozen or so recessions. There were financial panics. There was an oil shock. There was also a flu epidemic which happened almost 100 years back. It was known as the Spanish flu. And there was a resignation of a disgraced president. Yet, the Dow rose from 66 to 11,497. This is a representation of the US stock market. Whatever Warren Buffett has mentioned in the previous slide, these were not small events. These were gigantic events that had a great impact not only on the stock market but also on the economy. But if you look at it, the 20th century had all these events. This was a great depression which Buffett is mentioning. The stock markets fell by 89%. There were two world wars. There was an oil shock. All these things, in spite of that, if you look at the graph of the US stock market, it is going up. So the point that I'm trying to make here is, in spite of all these big events, the current pandemic would be one of the events. In spite of that, we can say that over the long term, we are going to overcome all these things, and the economy over the long term will improve. Some of you all may say, this is a US stock market, show me the Indian stock market. So I've got a representation for you. This is the Sensex. Sensex represents the Indian stock market. And in other words, you can expect a stock market to be a barometer of the economy in the long term. The data I have is from 1979 to 2020. And if in the mid 1980s, our country faced 3 years of continuous droughts and an economy which was predominantly dependent on agriculture back then, this was a big impact. Then in the year 90s, early 90s, we had the Harshad Mehta scam. In the early 2000s, we had three events that took place. We had the tech bubble, which happened in the US but had a great impact on India, Ketan Parekh scam, and the 9/11 terrorist attacks. And post that, we had the greatest bull run from 2003 to 2007. And then we were surprised by the global financial crisis. And if you see this fall, this is a 60% fall in over 14 months. This was taken up by a surprise. Most of the people across the world lost huge money in the global financial crisis. And of late, we had the impact of Corona in March 2020 here. The stock markets fell by almost 35% in like 40 days. This was a great impact. It was a great impact. And if you look at it, it is almost a 90-degree fall. You can see that, and we have never had such falls, such sharp falls in such a short period of time. But if you sit back, look at this picture, you realize that in spite of all these events, over a period of time, the stock market has gone up. In other words, we as an economy have improved. So the point number one that you need to take home is history proves that humanity has endured and overcome quite a few gigantic events. So the message here is there will be a tomorrow. Now we have around 90 minutes, but for the first 70 minutes, I will try to address you all. So first, I would like to offer my sympathies because you'll have to listen to me for like 70 minutes. It's not an easy task. I hope I don't bore you. And what I will do in these 70 minutes is the main idea that I would like to communicate is equity as an investment avenue. People usually consider equity or they equate equity with speculation. They equate equity with gambling. But here today, what my emphasis would be to say that equity is one of the most genuine investment avenues. And in a period of 70 minutes, I wouldn't be able to tell you everything about the stock market, but I will drop in a few ideas. I will give you a few ideas which, if you agree, I suggest you to develop on it at a later stage, and I will give you the relevant resources wherein you can use to develop on those ideas. This course, this session is not a how to get rich quick course. If you know one, let me know. Even I would like to know if there is a possibility on how to get rich quick. But as far as I know, as far as my little experience is concerned, I've realized that there is no way to get rich quick. And you may find courses maybe on social media or wherever of getting rich quick. They will tell you only about one specialization on getting rich quick, but they never tell you about the other specialization because there is a possibility of getting poor also. They never mention about that. But during my presentation, as we progress, I will make a clear point that there is no such thing as a free lunch. This is an investment universe. Like you and me, we have a lot of other investment options which we can use. But today, my focus will be on equity investments. Only one part of the investment universe I will be talking about. This is not the only thing. There are a lot of other aspects to consider when it comes to your investment. But my focus will be only on equity investments. Before I head to before I get into the details, I would like to tell you a story of a young intern. He was an energetic guy just out of college, and he visited a stockbroker's office back in the year 2002. He wanted to do an internship. He was all excited. He walks into a stockbroker's office and he says, "I want to intern," and he's offered an internship for 2 months. On day one of the internship, this was back in the year 2004. He sits there, and the stockbroker tells him, "Listen, you have 2 months. Sit and observe things. You will learn a lot." So this boy sits, and in the first half an hour of his internship, his boss gets a call uh, from one of his clients, and it is like LNT 95. LNT 95. Is it a good price to buy? So the stockbroker thinks for like 10 seconds. LNT 95. Is it a good price to buy? Ah, yes, it's a good price to buy. Go buy, he tells the client. After about 15-20 minutes, the stockbroker receives another call from another client. And another client says, 94, LNT, good price to sell. The stockbroker thinks for around 10-15 seconds. And 94, LNT, good price to sell. Ah, yeah, sell, he says. This young intern is confused. LNT 94, 5, good price to buy. 94, good price to sell. During lunch, he questions the stockbroker. He says, "What is this? 94 good price to sell, 95 good price to buy. What are you talking?" So the stockbroker says, "Listen, I asked you to only observe. Keep observing. If you want your stipend, what we do is whether people buy or sell, we make money. We don't really know whether it is a good price to buy, good price to sell. Ultimately, they have to buy and sell. If they buy and hold, we don't make money. So if they buy and sell only, then we make money. But the point that I'm trying to tell you is the financial services industry. You need to think when dealing with the financial services industry. Another story I would like to tell you about are two people, Grace Bronner and Richard Fuscoff. These are two people, both they didn't know each other, but their paths crossed in an interesting way. Grace Bronner was orphaned at the age of 12. She never married. She never had kids. She never drove a car. She lived mostly her life all alone in a cottage. She worked her entire life as a secretary. She was a lovely lady, but her life was a very humble life and very quiet life. In 2010, she died at the age of 100. But when she died, she left a $7 million for charity. $7 million. People who knew her were shocked. How come she had $7 million? They were wondering from where did the money get, where did she get it from? But there was no secret. She had received no inheritance, no gifts, nothing at all. What she did was, whatever humble savings she had invested in the stock markets, and she received the benefit of 80 years of compounding that took her wealth to almost $7 million. On the other hand, we had Richard Fuscott. Weeks after Grace died, Richard Fuscott, who was a vice chairman of Merrill Lynch, declared personal bankruptcy. He was no ordinary man. He educated the Harvard and University of Chicago. He was very successful in global finance and he ended up retiring at the age of 40. But few weeks after Grace died, he declared personal bankruptcy. The point that I'm trying to tell you is I'm not making a point that we have to be like Grace and we shouldn't be like Richard Fuscott. No, I'm not trying to tell you that, but what I'm trying to tell you is these stories happen in investing. That's because investing is not the study. It is not the study of finance. Investing is a study of how people behave with money. Now, every time I interact with students, I ask them, especially when I'm dealing with the stock market, I ask them, what is your perception about equity? Or what is your perception of the stock market? And in 99% of the cases, they say it's risky. It is dangerous. It's more like speculation. It's more like gambling. And I give them these three options. What is your perception about equity? Risky, damn risky. And 99% of the class says it is damn risky. So you can hold your opinion out there, whatever opinion you have, and let's discuss it. I know most of the people do not really have a good experience with equity or good opinion about equity. But what my objective in this session is to change your opinion, to make you consider that equity is indeed a genuine investment avenue. Now, some of you all would have watched this movie, a lovely movie, Tare Zameen Par. Uh, this was directed by Amir Khan back in the year 2007 or 8. The ones who haven't watched it, I will just let you know why I'm referring to this. This little boy, Ishan Avasthi, he's in the hospital when he is listening to the most beloved of his Hindi teacher makes him explain a Hindi poem. And in the Hindi poem, he says, जो दिखता है, वो होता नहीं. जो होता है, वो दिखता नहीं. It is a perfect description of just how what you see may not be the truth. And what is the truth you may not be able to see. I ask you a question. A gun, is it good or bad? Most of y'all will answer, a gun is not good or bad. It ultimately depends on the person who's using it. Let's say I use a gun for self-defense. Then we can consider that a gun is good. Let's say I use a gun to kill myself. Then at that point of time, we can consider a gun is bad. Similarly, equity is not good or bad. It depends upon the person who uses it. A person uses it for investment, he will receive the benefits of equity. But a person who uses it for speculation, then it is bad. Equity is not a good or bad. It depends the way you use it. If you use it for investment, excellent. If you use it for speculation, I think it can be dangerous. Now let me throw some light on what speculation is. The reason why I would like to tell you what speculation is, let me spend some time here. Reason is, most of the people, they think they are investing, but they end up speculating. They think they are investing, but they speculate. So it is very important to know the difference between investment and speculation. And there is a very thin line. We just do not know. We think we are investing, but we end up speculating, and which can cost us a lot when it comes to our wealth. So buying a lottery ticket. Buying a lottery ticket, you're very serious and you expect to win the lottery every time. That is nothing but speculation. Or in the morning, you buy the shares of Maruti Suzuki at 9:15 a.m. and you expect it to give you a 10% return at lunch. That is speculation. Uh, you're buying equity shares just because your friend has made a tenfold return in the stock market. That is speculation. Your friend will tell you he made a tenfold profit in the stock market, but he will never tell you about a 20-fold loss that he has made in the stock market. Or if you're buying equity shares just because the share price is going up, or if we are selling equity shares just because the share price is going down, that is speculation. And again, we need to question ourselves whether we are investing or speculating. This is in lighter vein. What Mark Twain says is October is one of the most dangerous months to speculate in stocks. The other months are July, Jan, September, April, November, May. You can use all the other 11 months. So basically, what he's trying to say is speculation is dangerous any time of the day, any minute of the day. The lesson I would tell you is जो दिखता है वो होता नहीं जो होता है वो दिखता नहीं. Here, let's make an attempt to see what the truth is actually. This is the story of stock market. Before, I will tell you about equity, but let me tell you what debt is. There are two broad investment categories, debt and equity. Let's say you have 10 lakh rupees. You go to your HDFC bank. You invest 10 lakh rupees for 1 year at 6%. After 1 year, if you go back to the bank, you will receive an interest of 60%. Whether HDFC Bank makes a huge profit, you will only get 60%, 60,000. If they make huge losses, you will only get 60,000. That's all. Whether they make profits or whether they make losses, you will be promised a return of 6%. To tell you a nature of what debt is, you are a lender of your money. And as equity. And this time you have 10 lakhs. You don't go to the bank, but you go to the stock market. You buy the shares of HDFC Bank. Now, if HDFC makes a huge profit, there is a possibility that your share price will go up. It won't go only to the extent of 60,000. There is a possibility that it can shoot up. If they make losses consistently, or if they make losses, there is a possibility that the stock price will go up. There is a possibility that you can see losses. To give you an idea of debt, debt is you are a lender. Equity is you are a owner. Now, this is the living room. Okay, this is your living room. This is my living room. This is everybody's living room. And one day, one weekend, sit and observe the kind of goods and services that you consume. For example, your air conditioner, your electrical appliances, your financial data, or the regular media, the cars that we have, the batteries inside the cars, let's say the tires, apparels, then jewelry. We shop from shop stop, then DMart, Future Retail, or footwear, the toys we have, the stationery that we have, consumer, the paints that we use, the furniture we use, the fast moving consumer that we use, our books, our stationeries. We consume the goods and services of so many companies. It's not only about you, it's not only about me. There are 130 crore Indians who consume the goods and services manufactured and produced by these companies. It's not only India, these companies have exposure even global. So we all consume, the word is consume, so we all consume goods and services of these companies. And there are lots and lots of people who put in their heart, their soul, and their mind, and they work for these companies. And the companies are run by the best in business. They are run by the best in business, they are from the best of these schools, and they manage these businesses. And one question to you is, instead of doing these products and services, do we own these companies? We use it, but do we own it? In spite of having an opportunity to do so. Now, here we have the business tycoons. We have Ratan Tata, we have Mukesh Ambani, we have Surinder Thillar, we have N. Chandrasekharan, Anand Mahindra, Gautam Adani, A.M. Nayak, Srinivasan. These are all big heads. So if you are investing in equity, have this idea that people like these are managing your business. Equity is nothing but an owner. So these people are managing your business. And if you get scared, of investing in equity, or if you are invested in equity and things are not really good at this time, you are in the best of company. You are in the best of company. So you can make this as a wallpaper and you will be like, okay, fine. Before you go to bed, you can see these people are managing your businesses. It doesn't mean that everyone is successful, but there are a few black sheep like Vijay Mallya and all that. But still, overall, you just expect these businesses to do well over the long term. So there is a small homework. If you want this list of companies, I will email it to you later. But for now, let's look into it. These are certain companies. Let's say these are top 50 companies by market capitalization listed on the national stock. Skim through it. But if you skim through this list, you will realize that these are not small companies. These form a huge part of the Indian economy. I've got the next 50 list too. I wouldn't spend more time on it, but get an idea that the top 100 companies listed on the National Stock Exchange by market cap are big companies. And if you run through that list, you will realize that you are aware of so many companies. We use the products and services of so many companies, but we may not really own them. The fourth point that you need to take home is whenever we talk about equity, let's try to understand the possibility of ownership. Now, when I mean to say I own shares of Reliance Industries, that means, yes, I'm a partial owner of Reliance Industries. Or if I own shares of Bharati Airtel, yes, I'm a partial owner of Bharati Airtel. But we do not really have the control or the right to say, just because my Airtel broadband is not working, I cannot go to Mukesh Ambani and say, Mukesh, bhai, listen, try to pull a wire of Jio on the road that I live in. No, we do not really have that option, but at least this is it's a closest wherein it can get to ownership. Let's say like we are a salaried profession. Let's consider we receive salary. We all receive salary, but we do not know how exactly ownership is, owning a business. But if you still want to own a business, the best thing is to invest in equity. So your businesses are managed by the best of brain. So you are partnering with the business tycoons. So let's say, for example, we are in a profession, like I'm in the financial services industry profession. So I'm in a business, but I'm in only one sector. But I want to get diversified. I want to have an exposure to information technology, automobile, wherein I may not have a capacity to run that business. I do not have the skills to run that business. But the next best thing that I can do is by investing in equity. So I am an owner in the automobile sector. I'm an owner in the information technology sector. I'm an owner in the pharmaceutical sector. I have an exposure to that. So the lesson here is, when it comes to equity, it is a possibility of ownership. Let me tell you an interesting story of Uncle Sam. You should be knowing, like you may not really know Uncle Sam, but if I tell you a story, you would be able to relate to one of the persons that you know. So Uncle Sam is like a big shot. Okay, he comes back from the Gulf in the year 1990. And person returning from the Gulf is like, oh, they come with big money, right? So Uncle came back in the year 1990. We call him Uncle Sam. So Uncle comes in the year 1990. He is aged 50. He has a fixed deposit of 20 lakhs. No, 20 lakhs looks small now, but 20 lakhs back in 1990 was roughly about 2 crore. 2 crore is like 2 crore. 2 crore is huge today, right? So back in 1990, 20 lakhs was huge. Uncle receives an interest of 10%. Let's say he keeps the money in bank fixed deposit. He's receiving 2 lakhs. His expenditure is also 2 lakhs per year. So that's roughly about 16,000 per month. Year 2000, uncle turns 60. His fixed deposit is 20 lakhs. The interest that he receives is still 2 lakhs. But his expenditure would have shot up. In the year 2010, uncle would have been 70. The value of his fixed deposit will be 20 lakhs. The interest that he's receiving is 2 lakhs, but his expenditure would have gone to 4.38. Now this interest is not sufficient. There is a possibility that he has to remove from the capital. This is a hypothetical case, so I'm showing you this. But when he's 80, which is very much a possibility, thanks to medical science, they will keep us alive till we die, right? The expenditure would shoot up to 6.48 per year. Then the interest you would receive is only 2 lakhs. Today, there is one of the invisible monsters, that is COVID-19. We all are COVID warriors. We all fight against COVID. But we never know what COVID will look like. But on a daily basis, we are learning about it. The best of doctors, the best of scientists are learning about it. Even the government is doing a tremendous effort when it comes to helping its citizens to cope up with COVID. But some of us may succumb to it. We can't really help, but I feel that human ingenuity will somehow overcome this invisible monster. But if you ask me, COVID-19, will it change the way we go about our investments? Will COVID-19 affect the way we should go about our investments? My answer is no. COVID-19 wouldn't change the way we should go about our investments. The way we should go about our investments have remained the same, will remain the same, and it will continue to remain the same. So the investment principles have been consistent for over not 3 decades, but 3 millennium. Back in 3000 BC, there was a concept of diversification which was written on diversification in the Talmud, a huge holy book, and it is applicable very much today as well. They have given a fancy name of asset allocation, but diversification and asset allocation has been there for such a long time. So COVID has not been the way we should go about our investment, but COVID has reminded us that we should have our personal financial plans in place, because something like this can happen again, and we have to be prepared for it. There is this monster of inflation. Inflation erodes the value of money. It is invisible. It is like a poison which had a great impact on Uncle Sam. It destroyed his life. And the solution or the vaccine to inflation is equity. Over the long term, the vaccine to beat the invisible monster of inflation in the long run. So your investments have to be, at least a certain portion of your investments have to be in equity, just in order to beat inflation. I've got a few numbers here. In April 1979, BSE sensitive index represents equity, performance of equity. So in 1979, the Sensex points were 124.15. On 25th June 2020, the Sensex closed at 34,842. So if you look at the CAGR, compounded annual growth rate, it's 14.64. Whereas gold, in 1979, the price of 10 grams gold was 937. In 2020, it's about 48,000. If you calculate the CAGR, it is 9.95%. Let me put up some numbers and show it to you. In 1979, let's say we have invested 10,000 in equity. The CAGR is 14% approximately. In 1979, let's say we have invested 10,000 in gold. And let's see CAGR, I've rounded it off to 10%. We have a CAGR of 10%. So the value of 10,000 in 1979 would have increased to 5 lakhs because it grew at a rate of 10%. Whereas equity, the value of 10,000 would have shot up to 26 lakhs. Now, if you look at it, there is a difference of only 5 percentage points. Has given you 10%, this has given you 14.9%. If you remember what Albert Einstein said, compounding is the eighth wonder of the world, the power of compounding. And we shouldn't underestimate even the difference of 1 percentage point in the long run. It can have an enormous impact on our wealth. So if I was made to draft the syllabus of primary school with the tables, I would have memorized that we shouldn't underestimate even a single percentage point in the long run. This is from 1981 to 2011. So this data is for 30 years. Inflation has been 8.3. That means on an annual basis, the prices of goods have increased at the rate of 8.3. Gold has grown at the rate of 8.79. It's not consistent, but over a period of time, we can consider the CAGR, compounded annual growth rate, to be 8.79. Bank FDs have increased at a rate of 9.17, or approximately you can consider the interest to be 9.17. Equity has given you a return of 16.75. See the difference here, it's 8.3, here it is 16.75. And in the previous slide, we discussed the difference of even a single percentage point over the long run. Some of you all may say, you spoke only about the Indian markets. What about the other markets? What about the global markets? But first, let me tell you a concept of real rate of return. I repeat, real rate of return. Your real rate of return is your nominal return, 16%, minus inflation, 8%. So your real rate of return is 8% because inflation is 8%. Here, we are focusing on the real rate on equities and bonds internationally from 1900 to 2006. Your inflation, you can consider it to be a substitute with bonds. Bonds is nothing but like your fixed deposit, similar to your fixed deposits. Just for an idea, I'm just giving you an idea here. Equity is 2.6 in Belgium. See the difference in all countries. Whether it's Germany, it's 3.3. Bonds have given you a negative interest rate. Reason negative is because of inflation. Okay, inflation and the return on your fixed deposits will more or less be the same. And that's the reason we see a negative interest rate. Let's say United Kingdom, 5.6 equity, wherein your bonds have given you 1.3. United States, 6%, whereas bonds have given you 1.9. And considering 5.8 and 1.6. So over the long term, equity comfortably gives you that optimum returns over the long term. So the lesson that we need to take here is equity investments have the potential to comfortably beat inflation and deliver optimum returns over the long run. So they have the potential to beat inflation and give you those extra, or let's say additional returns over the long term above your fixed deposits. The lesson 7 is even a single percentage point makes a massive difference to your wealth in the long term. Let's say gold gave you 10%, whereas equity gave you around 14%. This is for a period of 41 years. It looks like only 4, but this 4 percentage points can make almost 5 times difference in your wealth over the long term. This is one of the interesting slides. When I tell you that equity will give you 14.59%, or it has given 14.59% over in the past, or going forward we may get around 11% because inflation is reducing over a period of time. So this is what we expect is every year we expect to get 11%. And on an average also, we get 11% because every year we have got. But equity does not deliver returns that way. the way equity delivers returns is first year it will give you -8, second year maybe you will get 11%, third year you'll get a 0, fourth year you'll get 22, the fifth year you'll get -13, sixth year you'll get 22, seventh year 45, eighth year 26. Ultimately, on average, you receive 11%. In other words, it's known as CAGR, Compounded Annual Growth Rate. So when anyone talks to you about fluctuating investments like equity or gold, when they measure the returns over a period of time, we measure it using CAGR, Compounded Annual Growth Rate. That doesn't mean every year you get that return, but over a period of time, annually, you would have, it looks like you would have got a return of around 11% compounded, which is over a period of time. Back in 2000, let's say 2007, you had invested 1 lakh in Asian Paints. Let's say in 2007, this is 2007, you had invested 1 lakh. After 13 years, the value of your 1 lakh would be 16 lakhs. Your 1 lakh over a period of 13 years would have increased to 16 lakhs versus in a bank fixed deposit, 1 lakh would have been around 3 lakhs. Equity looks good, right? Equity looks exciting until and unless I show you the next one. Reliance Communication. Back in 2007, let's say I had invested 1 lakh in Reliance Communication in 2007. Today, the value would be 200 rupees only. Your 1 lakh has come down to 200 rupees. In January 2017, the paper Live Mint had this headline: Yes Bank turns Rana Kapoor into a billionaire as stock climbs. This was in January 2017. And in August 2019, Rana Kapoor loses 1 billion as Yes Bank shares slump 78%. Almost 20 months back, here Rana Kapoor became a billionaire. Here Rana Kapoor loses 1 billion. This is the stock price performance of Yes Bank. Let's say in 2018, August 2018, if you had 1 lakh worth, if you had invested in Yes Bank, today the value of it would be 7,000 rupees. 1 lakh would have come down to 7,000. I'm not trying to scare you all here. So what I'm trying to tell you is making a very important point, which I will explain in this very slide. This is a representation of two things. One is a representation of AIG, a single stock, and versus an index, in the sense a group of companies. It's not one company, but a group of companies. The blue line represents AIG. It represents, in short, it represents the performance of one company. The red line represents the performance of 5,000 companies. The data what we have is for almost 42 years, from 1975 to 2017. From 1975 to 1994, if you observe, both the performance of AIG, the single company, and the performance of the index was more or less the same. But 1994 onwards, your investments, if you were investing only in AIG, that was shooting up like anything. So it was giving you super normal return. So it looked foolish to stay invested in the index. But when the global financial crisis came in 2018, when it broke out, AIG tanked by almost 99%. See the fall, it's almost 90-degree fall. But you see a small blip here of the index, it's not a small fall. The stock market fell by around 55%. Now just look at this and observe. We have it's almost 20 years now. It's almost 20 years now. Sorry, it's almost 10 years now after the global financial crisis. And what we realize is AIG, though it fell down, it never came back to its original level. This is the level where it is now, and this is the original level. Whereas the index, a group of companies, though it fell by 55%, it managed to come back to its original level, and it is going upward. And if you see the direction of the index over a longer period of time, the market is going upward. This is the share price of the American International Group, AIG. This is during the global financial crisis. See the fall. It almost looks like joke falls of Shimoga, right? It's almost like poof, it's down, and it has never, even after 10, 13 years, it has never come back to its original level. So people who invested heavily in a single company would have lost everything. That is nothing but speculation. If you're betting only on one company, most of your wealth, okay, that would be. But if it's a small amount, it's okay. But that is another topic to discuss about. But here, what I'm trying to tell you is this: if you are invested heavily in one company, it can make a huge, huge impact on your wealth. The message is loud and clear. Invest in diversified equity that represents the economy. Don't invest in one company, invest in many companies that represent the economy. The Sensex for the past 1 year. Sensex is nothing but the stock market, how it performs, let's say, for the past 1 year, how it has performed for the past 1 year. So if you look at it, it looks like an ECG report, right? You see the fluctuations. You see the fluctuations over a period of time. And if we are heavily invested in equity, Sensex is nothing but diversified. In spite of investing heavily in diversified equity over a period of time, or at least in a short period of time, there are a lot of fluctuations. But if you see the same graph over the past 35 years, the same graph over the past 35 years, you see the fluctuations. You see the fluctuations, but you see the direction. The markets are going up over the long term. This is predicted, this is expected. So even if you invest there, volatility will continue. This is a part and parcel of the markets. We have to accept the markets the way they are, but this is expected, and over the long term you can expect the markets to go up. And some of y'all would be fans of Hollywood, so you may not be satisfied with the Indian data. I've got the US stock market here. It is represented by S&P 500. And even the US stock markets over a period of like 40 years, in spite of fluctuations, the markets have always gone up over the long term. So the lesson 9 is, in spite of fluctuations in the short run, the market always goes up in the long run. Now we come to a very interesting point. I'm asking you this question. It's very practical to what you and I do. So let's say we have 1,000 rupees a month. Every month, let's say we are able to set aside 1,000 rupees a month. Can we get exposed to the top 50 companies listed on the National Stock Exchange? These are the companies. I can send the list out here. See, the share price of Bajaj Auto is like 2,817. One share is costing that. Eicher Motors, which manufactures Royal Enfield bikes, is costing you around 18,000 for one share. Shree Cements, for one share, it is costing 22,000. And if you look at the list, you have so many big companies. If you look at it, these are like companies which have a huge presence. Then you have the next 50 companies. So I will take you to another list. You have huge companies that are listed in the stock exchange. But the question here is, with 1,000 rupees a month, can you get exposed to all these 1,000, sorry, to all these 100 companies? Whenever I take classes for students, I ask them these questions. So everyone starts thinking. I get different answers because I realize that students are thinking, and I wait for them to give me the right answer. And finally, there will be one student who gives me the answer. Yes, it is possible to invest with 1,000 rupees and get exposed to almost 100 companies which are listed on the stock market. And the answer is yes, it's possible through a mutual fund, an asset management company. Now, it's good to know what is a mutual fund. Generally, when I put this question across to students, students respond, mutual funds are subject to market risk. Please read the offer documents carefully before investing. But let's go beyond that. What exactly is a mutual fund? Let me just explain it practically. We have the investors like you and me. Let's say someone who wants to invest 1,000 rupees per month. There is another person who wants to invest 500 rupees a month. There is another person who wants to invest 10,000 rupees a month. So all have different requirements. We all have different requirements. And let's say we want to contribute a sum of rupees, a certain sum towards our investments. It may not be feasible, it may not be viable, or it may not be possible to go and diversify or lend money to 100 companies if you are investing in a liquid fund or a debt fund. Or similarly, with like even 10,000 rupees a month, it may not be possible to get exposed to all the 100 companies at one shot. At one single investment, we cannot get exposed to all 100 companies. So there is a concept of mutual fund. What is a mutual fund? What is the role of a mutual fund? The role of a mutual fund is nothing but asset management company. Asset management company. The role of a bank is to borrow money and to lend money. That's the job of a bank. Whereas the job of a mutual fund is to manage money. They will charge you a fee, which is a part of the process. They will charge you a fee, but understand their job is to manage money. Uh, there are these trusts. So listen, understand. The mutual fund does not have your money. The mutual fund only manages your money. Whereas you have the trustees. These are the trustees. They are responsible for money. Money is held by, in the name of the trustees, by the custodian. So these people only manage your money. It is held by a different entity called as a custodian bank, custody of your money. And finally, this is regulated by the Securities Exchange Board of India. I'll give you an example. Okay, HDFC Asset Management Company. HDFC Asset Management Company. HDFC Asset Management Company is sponsored by HDFC and Standard Life. So not everyone can go and start a mutual fund company. There has to be a sponsor. In the case of HDFC Asset Management Company, we have HDFC and Standard Life. Your money is invested in the markets. It's held by the trustees, who are majority of whom are independent of the asset management company. And the money is held by the custodian bank. Example of the custodian bank is a different entity, HDFC Bank, or let's say your Citigroup, Citibank, and Deutsche Bank. So these people have the custody of your assets. And ultimately, it is regulated by the Securities Exchange Board of India. So this is the structure of a mutual fund. Now, to give you, there are three types of mutual funds, or there are many types of mutual funds. But let's say you want to invest or you want to lend money. You'll want to lend money at something similar to your fixed deposits rates or something like that. Then you have something called as a debt mutual fund or liquid mutual fund. Let's say you want to invest in shares, but it may not be possibly viable to get exposed to like 100 companies. So we have these equity mutual funds. So what a mutual fund does is they collect money from all the investors and then go ahead and invest in it. So the broad categories of mutual funds are debt mutual fund, hybrid mutual fund, equity mutual fund, and you have also a gold mutual fund. I will take you all through. Well, let's say you do a systematic investment. I'm sure everyone would have heard about systematic investments. In mutual funds too, you have different funds. You have debt fund, you have equity fund. I'm just simplifying. Now, what I'm trying to focus on is your SIPs, because the session is more on equity. I'm focusing on your journey investing in an equity fund. Let's say you have invested 1,000 rupees every month, 1,000 rupees every month for 20 years. From 1st April 2000 to 1st June 2020. So it's a period of 20 years. It's actually 20 years plus 3 months. Investment avenue is diversified equity mutual fund. In mutual funds, you have something called as diversified equity mutual funds. So the total amount invested is, he's investing 1,000 rupees a month into 12 into 20 years. So that comes up to about 240 months plus those additional 3 months. So the total amount invested is 2,43,000 because he's investing 1,000 rupees every month over a period of 20 years and 3 months, which accumulates to 2,43,000. And if you look at the value after 20 years, the value is 12,33,000. This looks good. This looks excellent. But my focus is on the journey. It's not that easy. Okay, the 2,43,000 to 2,33,000. The person who had invested had to do nothing. And doing nothing is not so easy. In the year 2001, he would have invested 12,000. He's investing 1,000 rupees every month. By then, he would have invested 12,000. The market value is only 12,113. In the year 2002, March 2002, by then he would have invested 24,000. The value of his investment is 26,000. In March 2003, he's not seeing any growth, 36,000. The value of his investment is roughly about 39,000. But the fourth year, there is a surprise. It's 48,000, shoots up to 1,10,000. And life goes on. In January 2008, he has invested 94, but his investment has shot up to 4,99,000. Now, this looks really good. His investments during the global financial crisis, it came down by 150. But when the markets hit the bottom, this 4,99,000 would have come down to 2,45,000. It's almost 50% fall. He has invested 1,08,000. The value is 2,45,000. And this way it continues. In December 2019, he would have invested 2,37,000. The value of his investment is like 15 lakhs. It looks really big. And then we had the impact of coronavirus. See the investment. 15,000 would have come down to 10,000. So 10 lakhs. 15 lakhs would have come down to 10 lakhs. This is almost a 1/3 fall, almost a 33% fall in your investment value. And today the value is 2,43,000 he has invested. The value is 12,33,000. Now, if you ask me, what if this person had invested in a fixed instrument like recurring deposit? Okay, the journey is certain. The journey is predictable. The 2,43,000 would have been at 8% interest, would have been only 6 lakhs. If that person had invested in a recurring deposit, the value would be 6 lakhs. Now, your wealth is almost double. It's almost 10 lakhs. The fund is not done. The fund is going forward. In another 20 years, compounding, due to the power of compounding, this can shoot up. Wherein this would be only 10 to 12 lakhs, wherein this would be 36 lakhs. I'm giving an example. I'm just giving you an example how power of compounding works over the long term. I've shown only the first 20 years, but over the next 20 years, things can be different. And over the long period of time, the power of compounding will have a huge impact on your investments. Let me give you an example that whatever I told you about that systematic investment, that person started in the year 2000 until 2020. He's not bothered. All he does is ensures there is 1,000 rupees in his bank account every month. So he's investing it every month. Here. He's investing. He's not bothered whether the markets are going up, whether the markets are going down. Here it looks like the markets are up. It looks like the markets are at the peak, but he's not bothered. He continues investing. Now here, when you are standing here, this looks a bottom, right? One of the bottoms which we had earlier. But he keeps continuing investing every month. So here he would have started with 1,000 rupees. Here he has invested total amount invested is 2,43,000, but the value would have been roughly about 2 lakhs. this is how it goes. He's not bothered about the ups, he's not bothered about the downs. He keeps investing 1,000 rupees every month. Now, the case which I told you, it is one of the mutual funds. It is one of the mutual funds, but I wouldn't really mention the detail of it because it serves no purpose. The whole idea is it is an equity mutual fund, and all the funds in that category would have given you that return. So this mutual funds, what they did was they saw that they got a real good return. So around 13 point. If you see the CAGR, it's around 13.65. So what they did was they went back and saw the investment holdings of their investors, and they realized that the fund has given a return of around 13 to 14% over the period. The fund has given it, but have the investors got 14%? They went back they went through the details, and they found around 2% of the investors who had invested or stayed for 20 years. And this was a lump sum. That means they had invested in 2000 or 1999, and they held on for like 20 years. So this mutual fund people, they go back to the investors and they check with these people. And you know what? To their surprise, they found that the people who had invested were either dead or they had forgotten that they had invested. Okay, that's the reason they would have got this return. Rest of the investors, what they have done is they have come in, gone out, come in, gone out, come in, gone out. For example, what they have done is when the markets fall, they thought their investment values will fall further, so they come out of it. So that would have happened. So average return what the investor would have received is around 7%, in spite of the fund giving us 14%, and that is called the behavior gap. Beginning of the session, I told you investing is about the way we behave with our money. Some of you all will have a question. Investing in equity, there are two options. You have direct equity, in the sense you directly buy shares, versus you can invest in a mutual fund. Mutual fund has different kinds of funds. In one kind of fund is it's an mutual fund equity mutual fund. So you may ask me a question: what about investing directly buying the shares versus buying equity mutual funds? Now, I would like to make a point here. Investing directly in equity for a retail investor, like you and me. I'm not talking about these high net worth individuals, just a common retail investor who wants to invest in equity. What about what about buying stocks directly? Okay, uh, you can buy. There is a possibility you have a demat account, you can buy shares, but are we going to be successful at it is a question. And one of the authors, Roger Gibson, he says, when it comes to security selection, choosing securities that will be superior is extremely difficult. To choose stocks that will go up in the long run is extremely difficult, but not impossible. So I'm not eliminating. Some of you all may have the skills. You all can go by that. Ensure you're not speculating. Ensure you're not speculating. If you have those skills, if you're willing to devote that time in research, definitely go ahead and try that. But for the rest of us, this is for the 95% of the people. 5% have the capacity to invest. But for the rest, 95 do not really have the time, do not really have the skills. For the rest of us, it's better we go through the equity mutual funds. At first thing, I will ask you a question. Bajaj Auto, the share prices for one share it's 2008.7. Britannia Industries 3040. Bajaj Finance, one share costs around 2990. And if you look at the list of companies, all the companies, the share price of these companies are huge, are massive. So it may not be possible, let's say with 5,000 or 10,000 rupees per month, to get diversified across all 100 companies. So let me just do, it's always good to know when we are participating in the markets, it's also good to know who are the other players in the market. So I'm doing a comparison between a retail investor versus an institutional investor. A retail investor is just like you and me. The first thing is the volume. A volume of a retail investor. A volume of a retail investor can be between 50 to 10 to 50 lakhs. On average, I'm just giving an idea. I've taken it on a higher side purposely. But whereas an institutional investor, let's say just one mutual fund, there are some mutual funds that manage money of almost 10,000 crores. 10,000 crores is this is what they manage. And let's say they are charging a fee of 0.5%. An example, they are managing a fee of 0.5%. They would get around 50 crores as a fee. So with 50 crores, they can do a lot. And I'm talking about only one fund. They will have several funds with them. So with 50 crores, they can hire the best of resources. They can have the best of systems in place. Whereas we will be managing roughly about 10 to 50, whereas they are managing 10,000 crores. About the time, let's say we have 24 hours, 8 hours we spend on our work, 8 hours we spend, we need to sleep, and 8 hours is our own time. But we have a lot of other things to do. We have to spend time with family, we have to spend time on ourselves, pursuing our hobbies. So we are left with only 8 hours. But an institutional investor has around, let's say, around 1,000 employees, or let's say 100 employees, 100 employees into 8 hours. So they have 800 hours versus we have only 8 hours. So the reason why I'm telling you this, it's a market. You are a retail investor, you are one of our players. We also need to know who have the majority of the presence in the market. And coming to the resources, we may have, let's say, a laptop with, say, a couple of softwares. In terms of the resources, an institutional investor will have. They have the best of systems, they have the best of locations to get the right prices, to get the best prices. They have the best of people who are hired to do this job. They have the best of analysts. So where do we stand against institutional investor? And let's say coming to an entry background, we may do some research. We are whatever it is, individual auditing is limited. But whereas an institutional investor, they have a battalion of resources against. Some of you all will say that, but what about stock tips? Stock tips that we receive. What if we act on stock tips? I would like you to reflect on one thing. Stock tips. Just think. Why people who are selling stock tips are making money by sending you stock tips. Okay, making money by sending you stock tips, not by investing. So it's always important to know the intentions before we. This is I'm making some general comments, but you to reflect before you get into and start investing in the stock markets. Another important point I would like to discuss is buying low, selling high. Buying low and selling high. Some of us would like to say, let's say I will buy here, I will sell here. I will buy here, I will sell here. I will buy here when the market is up. I will sell here. I will buy here, or sorry, I will buy here and I will sell here. This looks good. This is excellent. Buying low, selling high. But the person who plans to do this, what he needs to do is he needs to stand here. This is 2020 June. He needs to stand here. The market is at 34,000. Looking back, but looking forward, we need to think which would be the next high, the next low, and when would it happen? It is impossible. Looking back, it's easy to tell you when which was a next high, which was the low. But looking forward, it's very difficult to tell which is the high and the low, and which would be the which would when would it happen. Buying low, sell high. Most of the retail investors try to do this: buying low and selling high. So buying low, selling high. If you practice that, selling high. If you practice this, we get in PowerPoints, what we get to know, if we try to do it in practice, it is more like this tongue twister. Okay, we do buying low, selling high, buying low, selling high. We keep saying that, and ultimately it will be buying high, selling low. So this would be the situation of most of the retail investors who try to buy low, sell high. They end up buying high and selling low. This is a diagram by itself. It's a beautiful diagram wherein he says the retail investors keep buying high, selling low, and ultimately repeat until broke, and they never get back to the stock market. Uh, so I'm heading towards the conclusion. So to be successful at investing, we need to have the information, we need to have the knowledge, we need to have the insights and wisdom. To be successful in investing, you need to have these details. But if you're not willing to put an effort, there is nothing wrong in taking professional advice. You'll find a lot of good advisors whom you have to reach out to guide you through this maze of the financial services industry. But my job here is to tell you how to get the information, how to get the knowledge, and from where do you look for insights and wisdom. To start off, if you want to keep yourself engaged and understand the basics of investments, I suggest you to go to this website, Franklin Templeton Investment. You can go to new to investing, new to mutual funds, and more about mutual funds. This will give you a basic idea on investments and mutual funds. And these are short videos. It's around 4-minute videos, different type of videos, which will give you basic on investment. If you are interested in reading, this is a good guide for personal finance. It's written by a financial journalist, Monica Hallan. She is part of Livewell, and she has written this beautiful book, Rich Talk Money. It's like straight talk investing. It is like to the point. So this will give you a good idea on how you need to deal with your personal finances. And if you want insights, if you want wisdom, these are the list of things you have to meet. Because even during market falls, if you have to stay course, you need to have that wisdom and insights, because otherwise it's going to be extremely difficult to stay the course when it comes to investments. So if I was asked to advise, y'all give me your advice in like 60 seconds, what would I say? What would I say? I know I was asked to speak on equity, but this is really important. Equity is one part of your entire investments. But what I would mention is, if I was just asked to advise you in 60 seconds, have an emergency fund. How much you need to have in your emergency fund is 12 months of your expenses. If your expenses are 40,000 per month, 40,000 per month into 12, it's about 4,80,000. This should be set aside in your emergency fund at least in 2 to 3 years. Into 2 to 3 years, you should have an emergency fund which is almost 12 months of your living expenses. The next is retirement fund. Most of y'all, if some of y'all are in their 20s, the 30s, you may look at me and you may like, this guy is mentioning about retirement fund. I've got around 3 more decades to retire. But this is one of the most important things which we should never look at. Let's say your salary is 6,000 per month. Per month, your salary is 60,000. So do not contribute a huge amount, only 6,000 towards the retirement fund. Contribute 6,000 towards the retirement fund. And where should your retirement fund invest? It should invest in diversified equity. To give you a quick example, diversified equity, you can go for index funds. Your emergency fund should be invested in debt instrument, similar to your fixed deposit or liquid mutual funds. Your retirement fund should be invested in diversified equity. And the third point is health insurance. In spite of your employer contributing health insurance, have your own health insurance for you and your nuclear family. Life insurance. This is something that I would like to say. There are a lot of life insurance products, but if you have financial independence, let's say you are a bachelor and there is no one to depend on your financial, on your income, then don't take life insurance, because even if something happens to us, you do not really have someone who's dependent on us. But if you have financial independence, you need to take life insurance. Life insurance, there are many products. But there is only one product that gives this. That is called as term life insurance. And of late, insurance industry has come up with gimmicks even with term life insurance. So when you are going for a product, ask a lot of questions, analyze, research, and then go for a term life insurance cover, because this is the only cover which makes sense if you have financial dependence. And ultimately, the last part is savings ratio. If your circumstances are normal, let me tell you, if your circumstances are normal, if you, in the sense, you do not really have a lot of responsibilities, you should be able to save 50% of your income. You should be able to save 50% of your income, and this should go towards it should be invested right. Uh, it should be invested right. What I suggest is you can read the book by Monica Hara, Let's Talk Money, and it will give you a good idea as to how you need to go about your personal finances. So coming to the conclusion, uh, okay, there is, if you ask me, is there any reliable way to double your money? Is there any reliable way to double your money? I thought about it. I thought about it a lot, and I came across one of the safest and most reliable ways to double your money. There is no other better way around, and the reason why I'm saying this is, this is just a short form of it, but what it means is there is no such thing as free lunch. There is no such thing as a free lunch. And again, if I was asked to draft a syllabus of the primary school, I would have ensured that they get this memorized, because whether in life, whether in economics, or whether in investments, you will realize that there is no such thing as a free lunch. And let me give you an advice here, especially when it comes to the financial services industry. A lot of people will start selling and pushing products to you. So when they push products, they will offer you a return of, let's say, 3% per month. This will convert into 36% per year. Or there will be some crazy policies which will be sold to you, offering you guarantee, it'll sound like guaranteed returns, but it's not. And at that point of time, what I suggest is you do a homework. You try to understand what are the FD rates at that point of time. The FD rates is, let's say currently it is 6%. So anyone who's offering guaranteed returns over 6%, you need to question him thoroughly. You need to understand how he is able to, when the bank is giving you 6%, how he is able to give you 7, 8, 9, 10. And if someone is offering you higher return, that means that there is a huge risk that is involved. And always remember, there is no such thing as free lunch. So what a second thing what you can do is, if any financial advisor or any person who's trying to push you products, you should ask him to show his portfolio, what he is investing in. So ultimately that really matters. If he's not eating his own food that he cooks at home, but he's offering it to outsiders, that means he's not thinking in your interest. So try to protect yourself from financial services industry. And I would like to say this: there is no such thing as free lunch. In our local language, Kannada, Uchita Tadanತಹ ಯಾವುದು ವಿಷಯಗಳಿಲ್ಲ. That means there is no such thing as free lunch. We have to put our efforts and question, and then go ahead when it comes to our investments. So if I was asked to summarize the whole thing in one slide, what I covered today, which is a beautiful topic, equally inspiring, was asked to cover in one slide, and this will be the slide. Paddy, which is very common in a place like Mangalore. Paddy yields, let's say, within 6 months. We sow and we get the crop in 6 months. As a coconut, again, it's very popular in this belt of the coastal Karnataka. Let's say coconut, we plant sapling. It takes around 8 to 10 years to get the fruit. Let's say we take a coconut sapling, we go to a paddy field, and can we expect it to give you a fruit in 6 months? Actually, the answer is no. It doesn't. We are well aware of it. And when it even when it comes to equity, it looks like at times equity gives you a short-term returns, but it is not sustainable for the long term. Equity is one of the beautiful and most genuine investment avenues which will give you good returns or has the probability to give you optimum returns over the long term. If you have any questions, I will take up the questions now, but if you have any further questions, you can always feel free to drop an email to this, or if you want this presentation slide, you can drop an email to this email account. I'm done with my session. If I hand it over to the organizers.
Yeah, thank you. Thank you. Can you hear me? Hello? Can you hear me? Can you hear me? Can you hear me? Hello? Can you hear me? Hello? Mr. Munir?
Mr. Yunil,
Yes.
Thank you very much
thank you very much for
the
the
enriching
very
session.
enriching
There
session.
are
There are
almost 30,
almost
35
30, 35
questions
questions
regarding this.
regarding this,
But let me take
but
only
let me
few.
take only few.
The first
The
question
first
was
question
from
was from
Praveen
Praveen
regarding
regarding
students.
students.
The question
The
was
question was
in
in
what
what
best way
best way
students can
students can
contribute for
contribute for
investments.
investments.
Uh, Students can contribute for investments in the sense, if a person, let's say, I've understood this question that way. If at all you have some pocket money that you receive, and if you are sure you do not need that money in the long term, if you're very sure you do not need that money for the next 10 years, then I suggest that you can pick up a Nifty 50 index fund, Nifty Next 50 index fund, 500 rupees in both these funds, and get exposed to the top 100 companies in India by market capitalization. So this is one of the best ways you can go about. But a student, if you want to save for your emergencies, you can invest in emergencies in the sense you need the money in the next 1, 2, 3 years, or you do not really know when you need the money. You can invest in a recurring deposit, or you can invest in a liquid mutual fund. But for your long-term requirements, let's say for your retirement, the best thing what you can do is start planning for your retirement right away. And small amounts, do not contribute huge amounts, small amounts which will compound over the long term.
Yeah, thank you. There is one more question from Praveen
I'm
Shinde.
not able to hear. I'm not able to hear.
Yeah. There is one
There
more
is one more
question from
question from
Praveen
Praveen
Shinde.
Shinde.
What is your
What is your
opinion for
opinion for
NPS
NPS
investments as a
investments as a
government
government
employee?
employee?
Okay, as a government employee, you are mandated. This is mandated by law, so you have no choice. Go ahead with it, because it is one of the good investment avenues. You get an exposure to equity as well, and we have no choice. If you are a government employee, it's okay to pick that investment up. In the sense, ultimately we have no choice. But be happy that you have an exposure in your NPS towards equity. So might as well continue with it.
Yeah, thank you.
Thank you.
One more
One
question
more
from
question from
Dr.
Dr.
Shubhasumi
Shubhasumi
Srivastava.
Srivastava.
If
If
I am an
I am an
investor who
investor who
neither
neither
resort to
resort
stock
to
market
stock market
advisor,
advisor,
nor I have
nor
a
I
plan
have a
to
plan
study
to
and
study and
observe the
observe
stock
the
market
stock market
changes,
changes,
which type
which
of
type of
investments fits
investments
for
fits
me?
for me?
Okay, again, it's not only about you, it's about most of us. We do not really have the time, the resources, the skills to keep tracking the markets, and it may not be really worth it. So the best thing, if you do not need money for the long term, if you do not, you're very sure you do not need the money for the long term, you are planning to invest systematically, I would suggest a diversified equity mutual fund. And in the diversified equity mutual fund, one of the best options is an index mutual fund, Nifty 50 index fund, Nifty Next 50 index fund, at a very low cost, at around 0.2%. You get exposed to the top 100 companies. So this is one of the best and the easiest ways to invest or participate in the economy of this country.
Thank you. The question from Sharat Kin. The final reconstruction scheme for S Bank, notified by the government on 13th March, has locked in existing shareholders for a period of 3 years, up to 75% of their shareholdings. Why they have done that?
Okay, see, ultimately they do not, once who are investing in Yes Bank, they want them to be serious investors. They do not want another round of speculation that can happen. So the ones who are committed with it, they have to continue. I know this was not told before, but that's the way it is. Otherwise, people would have pulled out their shares from the markets. So this is the way to go about. But again, if you would have diversified, it wouldn't really. If this Yes Bank would have been just 5% of your portfolio, it wouldn't really impact you over the long term.
There is one more question from many, in fact. Which is the best portfolio to invest in the situation of COVID-19?
Okay, for COVID-19, let me repeat this because has COVID-19 changed the way I should go about investments? The answer is no. COVID-19 is only a reminder to tell you that just have your financial plan in place. This is what COVID-19 has told us. Again, there is no portfolio to invest as such, but I would like to ask, you should go inside. You should ask yourself questions. Do I need money for emergencies? If I need money for emergencies, have I an emergency fund set up in place? If I have an emergency fund set up in place, no problem. Then I can go invest in diversified mutual funds. So I wouldn't suggest to pick a specific sector because we do not really know. And let me mention about Goldman Sachs. Sometime in February, Goldman Sachs is not a small company. It is one of the giants in global finance. And in February, they had mentioned that coronavirus wouldn't really have an impact on the world. It would have an impact only in China or maybe a few nearby countries here and there. A company like Goldman Sachs is predicting that. And what has happened today? So we cannot really predict the future. No one can predict the future. So the best way is by diversifying your investments across all sectors. So the best thing that you can do is through a diversified mutual fund.
Thank you. There is a question about SGB, whether it is worth to keep for 8 years in SGB.
Okay, sovereign gold bonds. It's a very good investment avenue. But when it comes to investments in gold, do not have investments. Oh, okay. Then a question is: are you considering it to be an investment, or are you considering it for, let's say, your daughter's wedding, which may come up over a period of time? So if it's for your personal use, go for sovereign gold bonds. It is one of a very good ways to invest in gold. But if you're considering gold to be an investment, ensure it is not more than 10% of your portfolio. And again, sovereign gold bond is beneficial because, in the sense, it shouldn't be more than 10% of your portfolio, because over the long term, as we discussed in this session, over the long term, gold does not really beat inflation. It's more or less where inflation is. And have only 10% of your portfolio in in gold. That's what I suggest. You can consider this. And another thing, when it comes to our predominant investments in equity, if it's for the long term. But again, if at all you are looking physical gold versus sovereign gold bond, a sovereign gold bond is any day good because you have a return of 2.75% on your investment, and plus there is no carriage cost, so you do not really have to worry about a theft.
Yeah, thank you. Can you touch a minute about tax relations, tax relaxation investment plans?
Okay, considering a normal investor like you and me, we have to look at tax saving options. So the government has given you two options this time. You can get away with all the exemption for this financial year. In the sense, it will be applicable, it will be assessed next year. So you have an option. You can either go for get rid of all the amendments, okay, and accept a new slab rate, which is a reduced slab rate, or you can continue with the existing regime wherein you have these tax saving options. Now, I have an advice in this forum. When I'm given 1 minute, I will just make a point. Let's say you want to take a benefit of DTC. Life insurance, I suggest have only term life insurance. So your premium may come up around 10,000, but still you are left with 1,40,000. Your EPS or NPS will come under that. Okay, again, you would have exhausted some more. Your children's tuition fees would have come under that. Your housing loan principal also comes under 1 lakh. Under that 1.5. Housing loan principal comes under that. Let's say you are still left with